Well, we have to watch it. We have to see how it moves. We have to watch the flow. Price action is more than just watching the price. You have to wait and be ready, not be blind. Instead, when you have the news on, you have Bloomberg, you have CNBC, you have all these things kind of being thrown at you with these radio talk show pundits telling you everything is bad, everything is good. Ignore it all. All these influences that we have are all bad for us because we are, in essence, listening to them and we're trading off what they're saying instead of really following what's on the chart. All right? Indicators that try to catch scalping or swing moves will always be behind. So when price makes a move, the bar or candle closes and posts. The indicator will always wait for the close of the move and then calculate what occurred, which will then plot the information. So it's late. The move is over and price is now moving into another direction, but you're trading off what just occurred off of an indicator. I have a presentation that you'll go see in a couple minutes that will demonstrate that with a little bit more color and action, and that will make much more sense later on. But for now, understand that price has a motion and a flow, and we can see it on the chart, and we should be trading off that. Okay? Now, something I want to bring to everyone's attention when trading is how to enter right and how to look to really enter and exit a trade based on what the chart is telling you. So an example here is you want to grab 60, just a number 60. You want to try to get this profit target. Let's say you're long here at 10 or 20 and you want to get 60, but 60 never happened, right? Didn't reach 60. Then you have the next candle here. It tried again and failed to go to 60. So you have your profit target up here at 60 or above 60, but yet what the price is showing you and what the price is telling you is that it's not able to get there. The third candle here does the same exact thing, goes almost to 60 and fails. Well, if price is telling you that it can't reach 60, you have here 1, 2, 3 candles, you should be analyzing what the chart is telling you. It's telling you it's not going to be able to get there. So if it's not getting up there, you should exit. If your profit target is at 60 or higher, you're never going to get it. And then the price tried a fourth time and failed and then collapsed. So one thing that I try to teach my traders, whether it be in the mentorship program or with the other courses I teach, I want to be able to grab their attention to this kind of market activity and tell them to front run a trade. And front running a trade is simply the art of getting in or out of the market one tick in front of it. So if you see a situation like this where the market is trying to get to a certain number and failing multiple times, in essence the price action is telling you, I'm not able to get it, I'm not able to grab 60, you need to get out of the trade. And maybe not by one candle or two candles, but when you look at 3, 4 candles, this is evident that you should look to exit the trade if you're looking to take profit. Alright, so front running a trade is really guaranteeing a fill one tick in front of the actual number you want based on what the price action is telling you. Alright, and many times price can touch a number and you will never get filled. It'll just touch it and touch it and touch it, and you won't get filled. Maybe you're at the back of the line. Maybe not enough contracts are being traded there for you to get your fill. It takes off without you. So front running a trade will eliminate that. Okay? If you want more info on that, I have lots of webinars all over the internet talking about front running, talking about first come, first serve. All these things help you as traders. The more information you know and you learn about what to expect, the better you are prepared when you trade. Alright, so this is what front running is. Okay? Indicators versus price action. Again, I have a few articles on the net talking about this. But in essence, when you compare an indicator versus price action, you're going to see that there are differences between what you can do with one, what you can do with the other, and which one is a leading indicator. So price action to me is a leading indicator. Indicators in general are lagging behind price. Okay? So have you noticed the markets lately? Last couple of weeks, summer trading, as you all know, or maybe not know, summer trading is much more difficult to do because the normal market movers and shakers aren't there to push it in one direction or another. So you have one large move in the morning, you have a block of data that is practically the whole day just a big range, and then you have a pop up or down. So this is typical summer trading. It's nothing new. I've seen it for many years now. I teach the mentorship guys how to trade it, but more importantly, I want you to know that indicators, any indicators that are trading this type of market action will always fail you. Okay? So if your indicators are failing you, it could be many reasons, but the most important reason would really be that summer action will get you a chop chop scenario, and you will be late entering that pop that occurs either in the morning or in the late afternoon before the markets close. Okay, they're impossible to use during this time frame. Recent market activity has been extremely erratic. So how can we trade this up and down, then pop, strong move up and down type action? How can we use this to our advantage? Well, let me show you a graph here that I've put together. And I want to show you really what occurs when you talk about indicators and when you talk about trading price action. All right? So the price here on number one moves up or down. Correspondingly, the indicator does nothing. It waits for the actual price to close. So the price makes a move, the indicator does nothing and waits until that close of the bar happens. On number two here, the price bar closes and the move is over, right? Price went up, price went down, whatever it is, the price bar just had a closing price, whether it be 1 minute, 5 minute, 30 minute, whatever. The indicator now calculates what the price just did. But the move is over. The move is over. It went up, it went down, it closed, and then the indicator calculates what just occurred and puts a point, a dot, a graph, a line on your chart. Number three here, price is now in a new move. It's on a new bar. It's making some type of up move or down move, but it's going in a new direction. And instead of that indicator telling you now what to do, you're trading off of what occurred back at step number two. Okay? So once the new move is over, the bar closes, the move is over, and then the indicator plots again late to the party, late to the scenario that the move is over, and it's telling you to do something based on what already has occurred. So in this graph, I want to demonstrate to you the actions of an indicator, how it's plotted, how it's created, as opposed to price that has already made its move and it's now in a new move, but you're trading off an indicator that has already or is plotting on something that has already happened. All right. So now, how we think as traders, how do we do it? We typically do not think of trading in the markets as normal people do. We think always in a little bit of difference, and let me show you what I mean by that. How we think as traders. Let's follow the price action, okay? If the market is going up, it's telling you something. It's telling you it's going up, right? So this is what we do as traders. The price is going up, and what are you doing? We're thinking, I'm looking to sell, right? Because the price is going up and we're inherently looking to sell. Price is still moving higher. And instead, you are thinking, I got to sell this thing, I got to sell this thing. The price is moving higher yet, and you are not following the price. Instead, you are thinking as a trader, where is this top? Where am I going to sell this? Instead of just following the beginning here of the step, right? The beginning of the step here is telling you the price is going up. And then it went up again. And it went up some more.